Right, rising inflation and a 17% hike in the minimum wage presents new considerations for investors in the Ghanaian government securities market. To get the latest on the fixed income market in Ghana, we are joined on the line by Samir Gadio, emerging market strategist at Standard Bank. Samir, thank you very much for joining us as always. A good place to start really will be your thoughts on the likely impact of this rise in minimum wage on inflation in Ghana, because the trend of inflation will certainly have a bearing on the trend for interest rates in the country.
Hello, Wally. Yes, well, obviously, it is to some extent probably a concern. I would say not so much actually because of the likely moderate impact on inflation, but because the increase in the minimum wage presently will probably send, in a sense, the wrong signal. The signal being that perhaps fiscal consolidation is not such a top priority in 2013. Right. And I think that's probably even more important than a moderate increase in inflation, because at the end of the day, at the short end, rates are still well in excess of 20%. So even if inflation increases from 10.4% by 1 or 2 percentage points throughout the year, which actually is not even a given, that's not really, a big issue. But I think the big issue is that the holders of bonds, especially the offshore holders of bonds, who are looking at the pace of fiscal consolidation, may get worried that actually we'll potentially not get where we should. And at that moment, they might actually decide to lighten up their exposure to Ghana. And in recent weeks, what we've seen really is that there has been some foreign selling of Ghanaian bonds, not in size, just a little bit, but that's already been enough to drive the exchange rate higher, and we're now almost at 1.98. So the perception is probably even more important than the fact, in a sense.
In your view, do you think investors who have been buying should continue buying Ghanaian bonds? The yields obviously look very attractive, but then we must always consider the exchange rate, which has weakened slightly this year.
Well, I think, in a sense, the irony is that, yes, those yields obviously look very attractive. Of the mainstream SSA frontier markets, it's difficult to ignore Ghana because clearly you get paid well at the long end of the curve. But at the same time, it's not also without risks, because those rates could actually back up in a situation where there is a fiscal gap, especially in the second half of the year, and the government actually starts to accept more bids at the auctions, which will then actually put some upward pressure on interest rates. Because let's remember that actually secondary market yields declined in relative terms versus 2012 at the beginning of 2013, because the government was able to stick to the amount on offer at the auctions. Will that be the case going forward? I think that's really the major concern. And if the currency keeps on getting under pressure, then actually some foreign investors may delay their entry in the market or actually sell. That's really, the dilemma, I think.